All right, let's unpack this. There's a company absolutely dominating financial headlines right now, capturing imaginations with some truly eye-popping numbers. But whenever there's that much excitement, it's always worth, hitting pause and taking a closer, unbiased look.
Absolutely. And what's particularly striking, I think, is that while the sheer growth is undeniable, history often offers valuable, sometimes, well, painful lessons about expectations versus reality in the market. Today, we're going to take a deep dive into Palantir, a company generating an immense amount of buzz,
Right.
and really dig into the question, is it an unstoppable innovator sort of on the brink of reshaping its industry, or are we maybe witnessing the makings of a new cautionary tale?
Yeah, that's the core question. Our mission today is to explore exactly that. We'll be scrutinizing the numbers, the narratives surrounding Palantir, looking at why it's so incredibly hot right now, what financial experts are genuinely saying, and critically, what its future performance would actually need to look like to justify its current, well, sky-high valuation. All of this, as always, is based on the comprehensive sources you've shared with us, particularly a detailed financial analysis titled Palantir's Precarious Peak, a cautionary tale, along with other relevant economic data.
Exactly. We'll try to simplify the key figures, connect them to the bigger picture of market history, and help you understand not just what is happening with Palantir, but why these dynamics matter for how we perceive value and growth in today's, let's face it, rather unique economy.
Okay, so let's start with the basics. What exactly is Palantir? Our sources describe it as a cutting-edge data analysis outfit, and it's currently dubbed the most searingly hot stock of 2025.
hmm
And when we say hot, we mean blistering. It reported revenue of, what, $1 billion for the second quarter of this year,
That's right, $1 billion.
which is a staggering 48% higher than the same period in 2024, and an astounding quadruple the figure from just 2020. That's explosive growth by any measure.
It really is. And that kind of growth leads to the crucial question. What makes them so special, so distinct? Why them? The sources highlight their Rule of 40 score, which is a key metric for software companies.
Okay.
It basically combines their operating margin and year-on-year sales growth. Palantir scores an incredible 94 on this measure.
94.
Yeah. To give you some context, a score above 40 is generally considered excellent for a software company. So 94 is truly extraordinary. It's testament to its operational efficiency alongside that growth.
So way above average then.
Oh, absolutely. It's actually higher than any other enterprise software firm of comparable or greater sales.
Mm-hmm.
And among the world's 25 biggest companies by market value, only NVIDIA, with its near monopoly on AI chips, scores higher.
NVIDIA.
And their competitive advantage, their moat, as they call it, it isn't just their sophisticated software and brilliant engineers. It's also a crucial high-level security clearance. This allows them to process highly classified information for U.S. defense and intelligence agencies. That's a barrier to entry few can overcome.
That makes a lot of sense. It really sounds like this blistering growth is largely fueled by the massive enthusiasm surrounding AI adoption for data analysis, which is just absolutely exploding right now.
Seems to be a huge factor, yes.
Okay, and this is where the plot thickens, right? With such phenomenal growth and these unique advantages, any investor would naturally want a piece of that action.
Of course.
But our sources bring up a critical counterpoint that demands attention. Palantir's market value, it has already soared to, what, $430 billion?
$430 billion, yeah. This is precisely where we need to dive into the valuation multiples, and this is where things get really interesting, maybe a bit concerning, depending on your view.
Okay.
Palantir's market value is more than 600 times its past year's earnings. 600 times. Whoa. To put that into perspective for you, that's nearly triple the equivalent multiple for Cisco, or even NVIDIA, at their historical peaks.
Triple their peaks.
Yep. Now, software firms, they often prefer to express valuation in terms of underlying sales, especially if they're reinvesting heavily and maybe earnings are low or volatile.
Right, the price to sales ratio.
Exactly. On that measure, Palantir's multiple is around 120.
120.
120. For comparison, back in 2005, Google's price to sales ratio peaked at 22.
22 versus 120. Okay, that's a huge difference.
It really highlights the scale of the current valuation.
And the sources explicitly point to Cisco as a truly potent cautionary tale here.
They do.
Think back to March 2000 for a few exhilarating days. Cisco actually was the world's most valuable company.
That dot-com era frenzy.
Right, valued at over 200 times its annual profit. In today's money, that's around a mind-boggling $1 trillion.
$1 trillion, yeah.
But even with solid growth since then, starting from such a stratospheric valuation, well, It ultimately led to deep disappointment for many early investors. Its market value today is around $280 billion, still far, far below its dot-com peak.
And that historical parallel prompts a vital question for us. Can Palantir genuinely avoid a similar fate? Is this time different? Adam Parker of Trivariate Research, a respected investment firm, recently published a note bluntly asking, could Palantir be the best short idea?
Ooh, that's direct.
It is. He analyzed the enterprise value to forecast sales ratio. Palantir scored 73 when he wrote his note in late May. It's now at 104.
Even higher now.
Yeah, it's climbed. Mr. Parker found only 14 other listed companies since 2000 that ever hit a multiple of 70 like that, and he excluded financial firms and those with less than $50 million in annual revenue.
Only 14 others.
Right. And the largest of those was Strategy, formerly MicroStrategy, which, interestingly, pitches itself as a Bitcoin treasury company. Its value is primarily derived from crypto holdings, not its actual operational sales. So maybe not the best comparison for Palantir's core business.
Interesting distinction. But what's even more telling, maybe a bit sobering, is what historically happened to those firms that reached these, dizzyingly high enterprise value to sales ratios.
Well, Mr. Parker looked into that. He actually lowered the bar for his study to a ratio of 30, just to get a larger sample size.
Okay, down to 30.
And he found that a year after hitting that level, the median firm had underperformed the S&P 500 index by 22%.
22% underperformance.
And on top of that, saw its multiple contract drastically, down to 18 on average.
Wow. That's not just a drop. That's a dramatic repricing.
It really is. History suggests these kinds of multiples are very hard to sustain.
So, okay, given all this historical context and the current valuations, what would it actually take? What does Palantir need to do to make its shares worth buying at their current price? What kind of future growth is already baked into that $430 billion valuation?
Well, the numbers from our source are quite specific on this. To reduce its price-to-sales valuation down to only Google's peak back in 2005, remember, that was 22.
Right, compared to 120 now.
Exactly. So to get down to 22 while maintaining its current share price, Palantir would need to multiply its revenue by an astounding 5.6 times.
5.6 times the current revenue.
Yes, and this would require an annual growth rate above 40%
Okay.
for the next 5 years, consistently, year after year.
Okay. Now, sustained revenue growth of that magnitude.
Right.
It's certainly possible, right? Even at Palantir scale. I mean, Google, now Alphabet, Meta, NVIDIA, they've all managed it for periods.
That's true. It is possible. These are exceptional companies, of course. But here's where the crucial distinction lies, according to the analysis. What's truly striking is that none of those historical success stories, and these are, like you said, among the most successful firms in history, none of them were priced to do so in advance.
Okay. That's the key difference.
That seems to be the crux of the argument. It suggests that true, generational growth is rarely fully anticipated and priced in by the market beforehand. It often emerges from maybe an underestimation, or at least not this level of baked-in expectation, which is a stark contrast to Palantir's current situation, where future perfection seems almost fully discounted already. In fact, on a recent call with analysts and investors, Alex Karp, Palantir's CEO, even admitted. He said their most recent quarter was, quote, a once-in-a-generation, truly anomalous quarter.
He said anomalous himself.
He did. Truly anomalous.
That's a stark admission. It basically means current shareholders. They need the company's revenue to continue to grow at a similar, truly extraordinary, anomalous rate, just to have a good chance of breaking even on their investment at this price.
That's the implication, yes.
Our sources clearly state there's basically no allowance baked into this price for an upstart competitor emerging.
Right.
No room for a scandal that makes clients wary, or even just a mere slowdown in that incredible growth trajectory.
No margin for error, it seems.
If any of those factors strike, Cisco may very well need to make way for a new, perhaps even more prominent, cautionary tale.
Exactly. What's fascinating here, or maybe concerning, is how much ideal future performance is already fully priced into the present moment for Palantir. It leaves almost no room for the unexpected challenges, the market shifts, or the competitive pressures that, let's be honest, inevitably arise in business over a 5-year period.
Yeah, reality tends to intrude.
It does. And this leaves us with an important question for you, the listener. How do we, as informed observers, truly balance the undeniable excitement of innovation and groundbreaking technology with the cold, hard facts of financial reality and these historical market patterns?
So, we've taken a deep dive today into Palantir, a company sitting squarely at the intersection of, groundbreaking data analysis and, frankly, sky-high market valuations. We've unpacked its impressive growth, examined those cautionary parallels to tech giants like Cisco, and rigorously explored the immense sustained growth that seems needed just to justify its current price tag.
Yeah, the story of Palantir, as presented in these sources anyway, is a powerful reminder of the dynamics of market exuberance and the indispensable role of fundamental analysis. It's about more than just the raw numbers, isn't it?
Right.
It's about discerning the narrative that surrounds a company and asking whether that narrative truly aligns with the plausible path required for sustainable success, or if maybe it's built on a foundation of perhaps overly optimistic assumptions.
So, what does this all mean for you as someone navigating the vast world of information trying to make sense of these things?
Well, for you, as someone absorbing and applying knowledge, maybe making investment decisions or just understanding the market, perhaps the biggest takeaway from this deep dive isn't really about whether Palantir specifically will succeed or fail in the long run.
Okay.
Rather, it's the broader lesson it offers about market psychology and perceived value. How do we, as informed observers, interpret these signals of rapid growth and seemingly endless high valuations? When does a competitive moat, like that security clearance, truly protect a company long term? And when does sheer market enthusiasm maybe lead to a precarious peak?
Good questions.
Consider this just as a final thought. In an age of unprecedented technological advancements, AI breakthroughs, seemingly infinite possibilities, how do you personally weigh the potential for truly transformative, maybe generational growth against the often repeated historical patterns of market cycles and, well, basic human optimism? It's a tough balance.